Welcome to Grain IQ. I'm your podcast host, Chad Moyer. Today we're going to continue our conversation about how you put together that risk management plan, and specifically today, how crop insurance plays a part in that. And I'd like to remind you as well, if this is your first podcast, welcome to the podcast. We have several seasons preceding this one. You just go to wherever you get your podcasts, download those earlier programs. There's a lot of great information there, a lot of great background information, and we're going to continue that conversation here. And of course, Grain IQ is a podcast of the Nebraska Rural Radio Association in partnership with the Nebraska Soybean Board. We thank the Nebraska Soybean Board for their sponsorship of this podcast. Joining us here today, it is Cory Walters. He is an associate professor in the Department of Ag Economics at the University of Nebraska Lincoln. Cory, thanks for joining us here today. Again, today's topic is crop insurance and how it plays a part in grain marketing. If you can just kind of take a half a step back, go high level, why is crop insurance, or why should crop insurance be a part of anybody's risk management plan?
Yeah, thank you, Chad, for having me in the first place. I'm very happy to be here. The big picture thought process behind crop insurance is that it rearranges financial outcomes. You are no longer subject to low yields and or low prices. You will get an indemnity payment from the insurance company to cover that, and in return, of course, you pay premiums no matter what the outcome is. And of course, we know those premiums are subsidized. So you're essentially sampling from a different distribution of outcomes than without crop insurance. And that is the epicenter of what insurance does. It allows you then to take that information, that different sampling distribution, different set of outcomes, and you can make a lot of decisions based on that around your farm in every aspect that you could possibly think of. It's endless.
Yeah. Well, and bigger and broader, it's called crop insurance, right? But we have auto insurance, we have homeowners insurance, we have we have life insurance, different insurance products that are out there. And what you're doing, you're trying to manage risk, right? It's important to understand what risk is and what that means to the individual. Is that a correct statement?
Yes. And I'm glad you brought up the auto insurance. So there's something very different between crop insurance and auto insurance. Is in our automobiles, we are subject to that accident. We can physically harm ourselves in that accident. So we are always maintaining, the best of our ability to be on the right side of the road, not get in a wreck. With crop insurance, on the other hand, it's not that you can want to go get in a wreck. It's now you can actually start doing other things around the farm, again, that allow you then to take advantage of this different distribution that you're sampling from, wherein in automobile insurance, if you start driving differently, you're putting harm on yourself, because if you decide you want to drive faster because you have insurance, well, that can end up pretty poorly. So it's a very different type of insurance, and therefore we have to think about it very differently. And crop insurance is over on the financial side, and everything on our farm has to do with financial management. And there's one thing we know: it is going to continue to grow in value, the financial management ability. We have to grow that both in our knowledge, because the markets are expanding in ways that are requiring that. And so we as individuals, as farmers, have to also up our knowledge of how these things interact, and importantly, to get rid of noise in the system and stick to the facts that really help us identify what things we need to focus on and what things we don't need to focus on.
Yep. All right. And we'll cover some of those things in today's podcast. But again, just some thoughts about, the fact that what you're trying to do is manage risk, right? Do you think that risk, that term risk, or what is an acceptable level of risk, is different from person to person or farm to farm?
Fundamentally, yes. Risk is very, very, very personal, because it has to do with your farm, your location, your cropping practices, irrigated or not. And it has to do with your financials as well. So, because crop insurance plays on both sides there, it uses yields and prices, and it turns that into financial management. And then you have to, you have a balance sheet, and you have to maintain that a certain level of equity there to maintain your farming operation. So all of this plays back and forth. And one thing we say very regularly, but I don't hear often a very strong definition of it, is the word risk. And I am defining risk as something that's, one, is very rare, and two, it's financially devastating. So we're down there in that area of the distribution where we have low yields and or low prices. We may not want to think about that area, but we do not know going into 2024 what yield or price we're going to end up with in the fall. And we have to manage rare events. If we want to think about being there in the future, we have to manage rare events and keep those things away from our set of outcomes that face us. Insurance is the number one protector of that. Is you get payments from the insurance company when you have low yields and or low prices. And again, it's not a prediction. It's just managing your distribution of outcomes, because right now on March 1, you can still change your crop insurance policy, and you can manage your distribution of outcomes right now. And if you wait until in the fall to just deal with something, you could get stuck in a corner, and that could be very financially bad on you and mentally as well.
Okay. Well, we'll come back and talk about how crop insurance is all put together and, what we're protecting and stuff like that. But since you brought it up, let's talk a little bit about that. What is an acceptable level of risk exposure for an operation? How do you go about determining that? Because, everything in agriculture is individualized. How do you figure out what you can and can't bear? You know what I mean?
Yeah, so we don't need to get down to, a penny of what we can and can't bear, but we can have a really strong set of heuristics to get to that. And so the basic idea to get to risk exposure is to calculate your guarantee, take off all your costs off of that guarantee, and then look at if you have a positive number or negative number. That's positive as profits, meaning even if the worst thing happens, your insurance guarantee is going to give you enough money to have positive profits. We go through years where at the beginning of the year, it's impossible to lose money in agriculture, in certain crops. And again, that varies wildly year for year. And if it's negative, then you need to find out how big that is. And do you have enough working capital to survive that? And that's the basic understanding of the power of insurance, is to give you the risk exposure and then manage that risk exposure accordingly.
So can you give me an example? And we don't have to go into like super detailed numbers, but just, roughly kind of walk me through what that might look like.
Yeah. So let's say you buy revenue protection at like 75%, that you have an APH of a certain value, multiply that APH times that 70%, multiply it by the 466 corn price we have today. That's your guarantee. Then of course you're going to have a budget of all your costs, and that thing needs to be true. You can't hide costs in that thing, but put all your costs in there and subtract that off of the guarantee and take a look at that thing and see what it is. And now, because we're before the end of the contract cutoff date here, we can change that contract. So then you could say, all right, well, what if I bump myself up to 75% coverage level or 80% coverage level? Or I could go down, and you can manage that then exposure, because you're passing some of it on to the insurance company.
Okay. Now, this might be a tangent, but how comprehensive should that expense list be? Because there are some things that require cash out right now, right? And then there are some things that are maybe non-cash, but still affect the bottom line. How extensive do you think that should be?
It's up to the individual, but I would try to be try to get everything in there that you think is valuable to calculate your exposure, so that you have enough money on hand to survive the upcoming year, so you can get into other years. With the commodity prices right now, you're literally looking at just get through these sort of years like we're facing now, and to get to more profitable years, we need to have a survival instinct in us. And so be honest about your costs, put all those cash costs in there, and then put anything else in there. If the value is unsure, let's say machinery repairs, put an expectation in there, but put something. Don't put it zero, because it's not true, and you're just shorting yourself.
Yeah, that's not practical. Let's be honest with ourselves and let's be practical at the same time, right?
Correct.
Yep. And you talked, here we are in 2024. That looks like the spring price is going to be around that 466 on corn. Do we have an idea what soybeans might be, what we might be able to calculate our guarantee is going to be there?
Yes, it's also about the 55 for soybeans. Yes.
Yeah, and then you can do the same thing, right? You start with 1155 and then your coverage level, APH, and take it from there, and you do the same thing, right?
I would repeat that perfectly. Yes, exactly that. And then, put in, if you're selling a certain type of soybeans or a certain type of corn, modify all that because it's down to your exposure for what exactly you're facing.
Okay. Let's talk about that. Let's say we do that. We initially we find our guarantee and then we come up with a number that we're going to start with on our expenses. Hypothetical, that number comes in negative based on what we have right now. What can we adjust to try and manage more risk at this point?
Yes. So you may actually not have to adjust anything. You may say, look, I see that number. And of course, that's across the farm. Now we take it per acre, multiply it number of acres, and do that for all your crops. And you'll have an exposure for the farm. Maybe you have enough working capital to survive that. So then you're in a great position. You should feel very powerful knowing that you can get through this year. And then that allows you mentally to also make other good decisions on the farm, because when we start getting down on things and thinking negatively, then it brings everything down around us. So we want to stay very positive and forward looking in this. If you don't like that number, then bump up your coverage level. That's one way of doing it. Of course, you'll pay a little more for it in premiums, but you also get more coverage on the exposure side. And the basic philosophy around this is you're not betting on a problem. You're trying to minimize the chance of farm ruin. So you don't know what's going to happen. You're just shifting that distribution around so that it can fit the goals that you want. Okay, so I'm not saying anything bad is going to happen. I'm saying if it does, you're protected. And then that opens up your mind to be really proactive on all the other decisions around the farm, instead of not looking at it and saying, well, I don't know if I want to fertilize as much, or I don't know if I should do that, or these sort of things. Then it just starts kind of snowballing into a poor decision environment.
So going back to what you said about, trying to come up with that whole farm number, I'm betting that there's a lot of cases where your margin on soybeans might be different than margin on corn. Maybe your operation allows you to adjust acres. Would that be a way to maybe adjust that whole farm number?
Absolutely. Yeah. The first step is maybe you shift a little bit of that. Maybe you think a little bit about the market, and you're like, well, maybe everyone else is going to shift too. And so then there'll be fewer acres of that crop that doesn't have as good of profitability in it, or worse exposure in it. And so maybe I do want to have some exposure in that because the market may reward me later on for doing that. So there's a lot of elements that come into this thing.
Mm-hmm. And then I want to come back to something else that you said. It's about with crop insurance. When you get that right, you said it allows you to make other decisions. Can you expand on that a little bit more? When you have your crop insurance in a good place, or a place that you feel like you've managed the right amount of risk, what can you do after that? What decisions does that allow you to make?
Yeah, so you then before insurance, when you started the year, you knew we had different government programs. We'll leave those out for now. I'm thinking farm bill stuff here, but there could be low yields or low prices. You had to be cognizant of that, and so that was very much in your mind about, well, what if the bad event happens? Now you've peeled that away. The bad event is now paid by the insurance company, and that then makes you want to see how can I improve my farm operation to be more efficient and effective, and ways you may want to adopt technology at a different rate. There could be those years where it's impossible to lose money, so crop insurance guarantees something really nice, and it makes you want to expand your farm operation because you realize how these programs are working, and then you adjust as that is appropriate.
Mm-hmm. What about marketing grain? There is a strategy to harvest market grain, and some people may say, well, that's dangerous. I don't have the commodity in my hands. I don't know what I'm going to have. Does crop insurance play a part in pre-harvest marketing?
Undoubtedly, yes. And it's comes down to understanding the financial tools that we're faced. Crop insurance, of course, guarantees a certain amount of bushels. We know that, but the markets also act in a certain way, and we can have a great debate about, do markets have seasonality in them? Do markets not have seasonality in them? How do I capture seasonality? But the basic idea is if we go with the market sentiment, then there is seasonality. So this is a long run approach. If you want to play season, you got to keep playing it year in, year out. But you would then want to start forward contracting at least a portion of your grain this during the growing season here. That would be your pre-harvest side. And you literally have no risk on the buyback side of it because insurance will be there for you. But you don't want to get too aggressive either if the bad event happens. There's years you can be really aggressive with pre-harvest selling because you do end up with a good yield. It's the ones that you end up in a poor yield and prices go way up. It gets really funky between insurance and the prices. So you still want to be tempered with how much you forward contract, but it's clearly above zero.
All right. So I guess, let's see, what haven't we covered yet? Oh, I guess we haven't covered yet some of those private or those, I call them auxiliary policies that you could, or buy-ons, attachments that you can do to crop insurance, SCO, ECO, some things like that. What part do they play in risk management and in grain marketing?
That is a very tough question. So the first part is when you go to those parametric policies, SCO, ECO, whole farm, margin protection, you're now working off of the county yield. So you're no longer on your yield. Okay, so you have the idea of risk management is that it would be tied to us strongly. So we're kind of loosening that tie a little bit, and that can get a little funky, especially if your financial standing is not very good. That I would caution against that because you may suffer the bad event, the county doesn't. There's no payment. And then you're having to deal with that financial condition on the farm that you started with. So it can be dangerous with SCO and ECO, but there's also a place for them. You can be very strategic on how you use those things. I particularly like using them when the prices are a lot higher because we know how markets work. When the prices are high and there's profitability on the table, well, it incentivizes us to plant more acres, and that production should lower prices. And then you have this policy there to help you when prices go down, but we don't know for sure if that will happen. It's just sliding around the distribution there a little bit. So all this sounds pretty good, but unfortunately, there's some other strategies out there where people are trying to save premium, and then they drop off their multi-peril, and then they buy up on SCO and ECO. I would very much caution against that strategy, just because I don't know your financial condition of the farm, and can you weather a storm that you suffer that the county doesn't suffer. And of course, across Nebraska, we have counties big, small, the soil types change. There's a lot of stuff that goes in there. That goes back to the risk being personal. But there's something else about these county policies. There are some counties around here in Nebraska now that you don't have a yield for irrigation and a yield for non-irrigated anymore. They actually blend them now. So if you go buy SCO, it's going to be a blended yield of county irrigated and non-irrigated. I'm taking corn, for example, here. And that wasn't the case a few years ago. You had irrigated corn and you wanted to buy SCO, then you would go and buy that thing, and you'd have a yield number at the county that was based on irrigation. So it was much more like you. But now some counties, and it varies, and I'm not sure why, but that's changed now. So that doesn't make SCO bad. We just have to be a little bit more strategic here on how we purchase that thing. So I'll just take for an example, an irrigated producer who's thinking about buying SCO in a county that has a blended yield. I would be interested in buying that, knowing that I have to wait to be paid. I have to wait around until there's a drought, because then those non-irrigated yields inside of that blend will pull that yield down, and voila, I'm going to get a payment. So you got to be strategic on how you think about these things. And of course, in that same example, you still have protection from, really rare years. In the irrigated side, I think of at the county level, remember at the county, 1993, very wet and had some early frosts that year as well, because we're talking county now, we're not talking farm. So the perils that the risks that hit us are different. And we have to be very aware of these things. And that was my statement earlier about we have to up our financial knowledge of how these markets work, how crop insurance works, how our environment around us is impacting us, because that appears to be changing as well. We got fires right now happening down in other states that are enormous. It wasn't too long ago that we had derechos hitting us not too far away. There's problems in private insurance floating around with premiums going up. Something appears to be happening, and we need to make sure that we're protected from that financially. It doesn't mean we believe it or not, but the farm health, financial health matters, regardless of what we think is happening in the environment. We have to make sure that we're being careful about how we're managing that going forward.
Yep. All right. So I guess kind of the takeaway on those private products, it's or those attachments, it's understand what you're buying, right? It's not individual, it's county. There might be some blended yields in there. Just understand what you're buying, right?
And your agent should be aware of this and able to look that up immediately to see where it's at.
Yep. All right. Very good. Well, we're kind of getting to the end of this podcast or this episode, I should say, Cory. Again, just what's the take-home message related to crop insurance, risk management, risk exposure? What do you want to make sure we know about crop insurance and the ability it gives us to market grain?
So the first thing is understand that distribution. Understand your exposure in that distribution, that financial exposure, and whether you can weather that or not, because we have time between now and the 14th here to change our contract to adjust that for our own individual exposure. And of course, we know risk is personal. We talked about that here pretty well. But once you get that exposure lined up and you can handle that, okay, it should relax your feelings about the year and knowing that if the bad event happens, you're going to make it, okay? Then we can focus on all the good things. There is a chance of also very nice yields or above APH yields and a reasonable price, and that also can provide some profits. So that's very nice. So you're managing a distribution right now. We're not thinking about, well, corn is just down from last year. You notice I've never said anything about last year. You have to be very forward looking. We're in this market. We have to trade this market. It's the market we have. Trade the market you have, not the market you want. So here we are right now. Use this information. Use the seasonality thing how you wish, but come up with a very positive, forward-looking plan to make good decisions so that you can be there if bad things happen and also gain when good things happen.
Yep. And if folks want to get more information, I know the UNL has the Center for Ag Profitability. There's a lot of budgets on there, a lot of tools, things that can walk you through some of these things in a format that you can see in front of you, right?
Absolutely.
Yep. Very good. Cory, thank you so much for joining us today. Appreciate it.
Thank you for having me, Chad.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Makovica. Our project manager is Bryce Duskid. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.